We invest in cash bonds issued in US dollars with a goal of providing income via distributions. We're not managing to a benchmark. We're not buying options. We're not buying local currency bonds. We're really just thinking about US dollar cash bonds from Latin American corporates to get that steady income for our clients.
Hello, you're watching Proactive. I'm joined by Baylor Lancaster Samuel, the Chief Investment Officer at Amaranth Investments. Baylor, very good to meet you. Let's start with the basics. What is the Amaranth Latin America Debt UCITS ETF, and what gap in the market is it aiming to fill?
Thank you so much for having me, Stephen, and it's a pleasure to be here. Our ETF is Amaranth's first pooled investment vehicle. We're so excited to launch it, and we really launched it to meet a client need. We have a lot of Latin American clients that are comfortable and familiar investing in their home countries. But on a practical level, it can be a little challenging to build a bond portfolio for these clients. One of the reasons is that the bonds tend to have minimum denomination sizes of 200,000 pieces. And so for a client that has, say, $1 or $2 million to invest, they really can't build a fully diversified portfolio. You need sort of $5 to $6 million in order to get enough diversity to build out a robust fixed income portfolio for Latin American corporates. So we saw that this was a gap in the market, and we decided to build our own ETF to build a steady distribution yield and provide income for our clients.
As you mentioned, our NTA focuses on Latin American corporate bonds. Can you explain the active strategy behind the fund? What kind of companies and countries you're targeting and why?
We think an active approach is the key for most all fixed income investing. And it's very simple. Let me just explain why we think about that. If you think about a bond index, by definition, the largest constituents are those that have the most debt outstanding. So you have to be very careful there because you can end up indexing into stress situations. We think it makes it critical to understand risks and evaluate the issuers without buying passively for fixed income. Now, when you think about Latin American corporates, we think an active approach is even more crucial. You need to understand the politics in every country, think about the companies, their liquidity, their management team, their strategies, and on and on. So, an active approach is foundational to what it is that we do. Now, to drill in a little bit deeper, we look for companies within the largest and most stable economies in Latin America. So we're talking Brazil, Mexico, Colombia, Chile, things like that. And I don't know if everybody knows this, but I'll just mention it. Brazil's population is over 200 million people, and Mexico is over 130 million. So these are sizable growing economies that we feel comfortable investing in. When we say stable economies, that can be relative. Of course, we see moves to the left and to the right over different cycles in Latin American politics. And we're not naive that some of the institutions in these countries are not as strong as maybe we would be used to in the Western world. Although, of course, if you live in America today, we have some questions about the strength of our own institutions. So fair enough. But we are comfortable in the economies we invest in, and you have to be comfortable to invest in LATAM at all to tolerate a bit of political noise. Now, the last thing I'll mention here is that we focus on performing credits. This is not a distressed investing strategy. For instance, we have no exposure at all to Venezuela in the ETF. We also are cautious on sort of serial defaulting nations, the RGs of the world, the smaller economies in the Caribbean, for example. So what we're really focused on here is the largest companies in the largest economies of Latin America.
Just taking that active approach a little bit further, Latin America offers attractive yields, but also carries perceived risks. How does active management help you manage default and political risks across the region?
Yeah, you're right. When you venture into emerging markets investing, it definitely becomes a balancing act between attractive yields and watching out for downside risks. Certainly, we have seen recently there's been a broad-based sell-off in Brazilian corporate bonds, and that Brazil is our largest country exposure in the ETF. So that can be a little painful as we see some of our favorite names go wider, and we think sometimes these moves are unjustified. That comes with the territory, and we're mindful that volatility can also be an opportunity. The other thing to note is that our ETF can be relatively concentrated. We're targeting 40 to 60 names at any one time. So the NAV performance can be a little volatile given that we have rather concentrated positions, and this compares to funds that would have hundreds or maybe thousands of positions. But that's where the active approach can really shine. We make conviction views and we believe in our credits. Obviously, if the facts change, we have to change our mind, but that's the approach we take. The last thing I'll mention is that we're managing our ETF for income. And so, to some extent, we encourage clients to look past any NAV volatility and just focus on that income. We pay a quarterly distribution. We aim to keep it steady. And we think about the portfolio largely in terms of carry. So, we're not necessarily thinking about a lot of NAV appreciation, especially for performing credits. We just think about the carry and the income that you get from those bonds. Lastly, I'll say that we've done a bit of work on LATAM in particular relative to other regions. And one thing we found is that Latin America does trade cheap compared to other regions. So, what I'm talking about here is when you're thinking about what spread over treasuries you get relative to other regions for a given rating. So, we looked at spread per turn of leverage. So, how much extra spread you're getting on a bond relative to the underlying leverage of the company. And across all rating categories, Latin American corporates trade with additional spread for the same amount of leverage. So we think that's a great opportunity, and we're trying to capture those investments.
You've structured the ETF to invest in US dollar denominated bonds. Why was that important, and how does it change the risk profile for international investors?
Yes, thank you. We did make a decision to invest only in US dollar bonds, and that really comes to where we think we can add value. My training is in credit, which I've done for my entire career at this point. It's 25 years. So we're talking through the TMT bubble of 1999 to 2000, the global financial crisis, 2008 to 2009, the Eurozone crisis, COVID sell-off, and many more. And that's why I have all this gray hair. So these cycles really test your training, and we believe you can invest wisely through the region and through having the experience to manage through rough patches without panicking. Now, the thing about currency is you could definitely add local currency bonds to an EM strategy, and many of our peers do, but we just don't think we can add value by making calls on the currency. By staying with US dollar assets, we take away this source of volatility. And a more sort of prosaic reason for this choice is that many of our clients are domiciled in Latin America. And so, in some way, their life is already exposed to local currency. So, they really want those US dollar assets. They don't want to take that currency risk, but they're comfortable with the corporates inside their countries. Lastly, we would say that the issuers profile for Latin American corporates that issue in US dollars tend to be the largest companies within the region. They are often export oriented. Sometimes they have their revenue in dollars, and they can be country champions, if you will. So we really think this is the best of the best in LATAM, and we take a view to invest only in US dollars.
What type of investor do you see RNTA appealing to, and how might it fit in within a broader fixed income or global portfolio?
Yeah, I would say RNTA, you sort of hit it there on the ticker. That means yield in Spanish. It's a very straightforward strategy. We invest in cash bonds issued in US dollars with a goal of providing income via distributions. We're not managing to a benchmark. We're not buying options. We're not buying local currency bonds. We're really just thinking about US dollar cash bonds from Latin American corporates to get that steady income for our clients. We think that Latin America has very favorable demographics, long-term growth, and we have found that they have very attractive yields and carry. So I see two potential investors for our product, those looking for steady income that are comfortable owning the best and largest companies in Latin America, and also for institutional investors that have a sleeve for EM exposure. As far as I know, there's no other ETF out there that focuses on Latin American corporate bonds at this time. It's a very liquid and low cost structure, and we think can fit nicely into institutional portfolios as well as retail.
Miller, thank you very much for the introduction to the fund. I'm sure we'll be chatting again in the future.
Well, I appreciate your time. Thank you so much.
Baylor Lancaster Samuel, the Chief Investment Officer at Amaranth Investments.